answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are with us today, both myself and my co-host here. We're both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays with people like yourself, come here on weekends to be your financial advisors on the air. And glad you are here with us as we are talking about financial matters. Of course, we'll talk about the current economy and the markets, as well as taking your calls. If you want to join us, 833-99-WORTH is the number, 833-99-WORTH. And
so it's a, Scott, I came across this article and I thought this was quite interesting. We have talked about governments in the past issuing 0% bonds that pay zero. And in fact,
Or negative,
some negative. I think a couple of weeks we were talking about the Czech Republic and a couple other ones like that. Well, it's
amazing you think of some of these countries that went negative. I think Spain went negative. Portugal went negative. Remember, it wasn't that many years ago that people were freaking out that they were going to default on their bonds.
Yes.
Now
they're negative.
Now people say, here, you take my money, like take my euros and give me back just most of them.
Yeah, and the interest rates, it wasn't that long ago where they were in the 10s and 12s and 15s. And
people have short-term memories.
How long ago was that? It was in the 2011,
that was probably
12?
10 years ago.
2010.
I remember I chaired an investment committee for it was a non-profit organization. I don't want to say too much. I don't want to give any heads off what it was. And it was the classic where this little thing happened, and all of a sudden, people on the board wanted to know an explanation of what percentage of the portfolio is in Portuguese bonds. Should we get rid of our Portuguese bonds? And of course, it was like 0.2% of the portfolio or something, right? And I just remember the time. It's like people that haven't understood. Yeah, but sometimes these people on investment committees have no concept.
But in reality, you would have wanted to load up on the Portuguese bonds if they go down.
When there's blood in the street, that's when there's buying opportunity. Yeah. When everyone's euphoric and toasting champagne, that's usually the time to run for cover.
Yeah, and as the interest rates are high, as the interest rates go down, the values increase in the bonds. But this Danish home finance company, the Danes, Nordea Bank, ABP, has now issued a 0% mortgage, 20%, 0% mortgage. I thought they were low in the U.S.
0% mortgage.
Yeah. So a friend of mine who was he was looking for a new job, he said, Pat, what do you think about me getting into home mortgages? And I said, I'm the wrong guy to ask.
Because 10 years ago you said it was, how much lower can rates go?
Right? That's exactly what I said to him. I said, I am absolutely the wrong guy to ask, because 10 years ago, I thought these things can't get any lower. And even when they couldn't get any lower, the government was subsidizing some sort of a refinance program a couple years ago. Anyway.
Well, I do also recall the early 90s, my friend was going to open a coffee shop. I was living in the city of Folsom at the time, Folsom in Northern California, the Johnny Cash Folsom. And I said, what, are you kidding me? I said, there are already 2 Starbucks in this city.
2 Starbucks. I went to
2 every corner.
I went to a Starbucks that actually had a Starbucks inside of it.
But it's amazing how low interest rates have got.
Yes.
Which is part of what's driving markets higher. Money's free. Right there, it's free.
Basically, yes.
Not basically, that's free.
That's free.
A 0% mortgage, that is free money.
Yes.
You got to pay it back, but you can use it for the next 20 years.
And corporations refinance the same way individuals refinance.
Rates are low. It's like, holy crud. Let's take advantage of it.
Yeah. And in fact, corporations will issue new bonds at low interest rates, even though they don't have a use for them at times. It's not unusual at all.
And I know there's some people kind of wondering what's going to happen now with the new administration coming in, which will just be this next week. What's going to happen? Of course, We know what was stated on the campaign trail, and what we'll see what bills get pushed forward are probably two different things.
Yes.
Reality. That's they tend to say things to appeal to various.
It's like the difference between dating and getting married.
Nice.
The real self comes out once you're married. Was that a bad analogy?
That's a bad analogy, yeah. But I think people kind of understand what you mean. But obviously, I think this is the first election that people didn't call the day after saying they were going to get out, only because it was undecided.
Yes.
It took a long time to do the counting, and there's still the recount, and we know the recount's still stolen, all that stuff, right? So we didn't have that day after election. But invariably, it doesn't matter. Every 2 years when there's an election, depending on which party takes control, there's clients. We've got 13,000 clients or whatever here at Allworth, and there'll be clients that'll call and say, "Oh my gosh, this is the worst thing ever. These guys are going to gals and go. They're going to destroy the country. I need to sell everything I've got and put it to cash."
And an equal number of clients that will call and say, "This is the best thing that's ever happened. I need to increase
Yeah,
my
that's
equity
right.
exposure."
But here's an interesting thing. If we go back and look at some of the history, I'm just stating this as it is. Since 1944, this was a CFRA had published this. They did the research on this. Whenever Democrats had a unified government, the average annual return for the S&P 500, unified government, right? That's what we got now. We got the presidency, or what we'll have here in the next week, presidency, both chambers of Congress. Whenever they've had a united government, the average annual return of the S&P 500 was 9.8%.
I found that pretty spectacular.
That's just what's happened historically. Doesn't mean it's going to happen now.
No. Do you expect any changes in tax law?
Yes.
The first year?
I don't know if we'll see anything right away.
Yeah, I don't think so.
No, they're going to give more money away.
Yeah.
The $600 wasn't enough, so $2,000. I say, why not just $100,000 to every individual in the United States?
Okay.
Why stop at $2,000?
Okay. Well, okay.
Let's give everyone a good life, not just a mediocre.
Yeah.
one.
Well, obviously, if everyone had 100,000, then
I don't think most people are very supportive of just writing blank checks to everybody based upon regardless of need. So anyway, we'll see.
I doubt anything happens in the first 6 to 12 months.
But if you're sitting there monitoring these economic reports, thinking you're going to make investment decisions based upon what's happening in the economy, we would strongly suggest against that. Now, perhaps you can make an argument based upon how much the Fed is sloshing money out, but the economy creates more money now than banks do. The way that the lending occurs in these side shadow banking systems.
Yes,
So,
well, especially outside the United States.
but there's some listeners right now that, and you know who you are, that you sold a good chunk of your stocks, if not all, last March.
Yep.
And there's some of you that maybe now is a good time to be selling some chunk of your stocks to get back to a more realistic weighting.
You most certainly should make sure that your portfolio is rebalanced.
If you think back, we had in the year 2000, we had a period of time after 2000, the dot-com bubble. It peaked in March of 2000. We didn't hit the bottom until I believe it was November of 2002. 2.5 years of this slow grinding down. The S&P 500 went down about 45%. 2.5 years of this prolonged decline.
And what year was that?
Between 2000 and 2002. After the tech bubble.
Yep.
And the NASDAQ went from 5,000 to under 2,000.
Yep.
Destroyed.
And how long did it take to get?
Technology stocks.
It took
it took a long time
time
to get back to new high. Now we're at this time of this tremendous euphoria of investors. Things have gone up like crazy. People making money on Robinhood app. They can't believe how much money they're making. You have 20-year-olds start to tell their parents how to invest their dollars. That's what's happening, right? It's just this kind of strange time. And I think not that we are predicting that this is going to be a bad year economically, because who knows? But if you think back, we've had, in the last 20 years, we had 2 periods of times where the stock market was down roughly 50%. One was the period that lasted for 2.5 years of declines. Not 2.5 years to get to new highs. 2.5 years of these gradual, demoralizing
slog
declines.
Down.
Where it's like you're looking at each other at home saying, oh my gosh, if we have another couple months like this, we're going to have to go back, quit retirement's off the table, or we're going to have to go back to work. And then we had the financial crisis. That was much quicker.
Oh, it was fast. And then we had this last year.
Which was even quicker.
It was unbelievable.
But my point is, our point, prepare for another major downturn. That doesn't mean you need to sell all your growth stocks or sell your stocks, but have a good understanding. Do a stress test in your portfolio. Like, what would things look like if the market fell 50%? How would your portfolio react? And can you still, are things structured in such a manner that it can still provide the retirement income that you need for?
Which means,
do you have a market downturn that's going to take 5+ years to recover?
Do you have enough in bond that you could provide
And
that
cash.
monthly income in order to allow the rest of the portfolio to recover? Because you don't know what's going to happen. You absolutely don't know. You do not know. It will be something that has not been on anyone's radar.
But if you prepare for the worst in your finances,
then
nothing bad's going to ever really happen, right?
Well, you're going to see some volatility, but you're expecting it.
If you look at volatility as that's the price
That's
that you
the cost.
pay to get these excess returns, then that's not a bad thing either.
That's right. That's why it pays above what historically it has paid over the long term above what a U.S. Treasury has paid. That's the cost of that. Volatility is the cost of the excess returns.
So we'll see how this year plays out. Who knows?
Yeah. Actually, I remember a friend, he was buying a hotel 2 years ago, and he was talking about financing it with me. He was buying a hotel, and he said, what could go wrong? And I said to him,
who knows?
I said to him, it's a hotel. I said to him, there are things that are going to happen that if we sat in a room today for days and tried to list them all, we would miss a few. And I'm sure, quite frankly, had we done that, we probably would have missed pandemic affecting hotels. And so he didn't lever it all up. He didn't put tons of leverage on it, which was my point, which is, look, if you're going to own this thing if you're an owner or you're a speculator, if you're an owner, then be careful with leverage, debt.
Yep.
If you're a speculator, pile on.
Yeah, right.
Right?
Pile on. Use options, triple inversion, or all that other garbage.
Yeah, if you're a speculator, use debt. Pile on.
All right, let's start taking some calls here. 833-99-WORTH is the number to be part of our program. We're talking with Daryl. Daryl, you're with Allworth's Money Matters.
Is it Daryl?
Yes, hi, Daryl.
Hey, good afternoon, gentlemen. Scott and Pat, thank you all for taking my call.
Yes.
I wish I had 30 minutes to talk to you and just suck your brains. Let me tell you a quick intro.
Thanks.
That
sounds really exciting.
Yeah, I'm very high risk when it comes to investing, and I hope and pray that the kids are high risk. We have 5 children, which are grown now, the youngest being 27 years old. I grew up in the projects, very low-income area. I'm not a college graduate or anything, but what I did when I graduated, I went right into the military, the Marine Corps, the very next day, and I retired, did my 20 there. And then I came out and went to the Postal Service, and I'm at over 20 there.
God bless you.
So I think I'm putting all my beings right there with the government, basically. So, but my question is pertaining to our grandchildren. We have 6 of them, and I'm interested in what are some of the investment programs that myself and my wife, can do for them. If you have any advice or insight on that
What are you trying to accomplish?
My goal is for them when they're 25 years old or 30 is to have a lot amount of money set aside for if they decide to go to school or open a business of that nature. So that's growth income.
And when you say, is it primarily school or is it business? And at any point in time, would you like the ability to retrieve those dollars if you think that they were going to use them in a manner that isn't consistent with your beliefs?
Yes.
Okay.
So I mean,
would.
there's we can talk about some different avenues that you can use, and then the pros and cons to that, right? One avenue
Correct.
is use what's called 529 plans. These are designed for education costs. The benefit of a 529 plan, inside of a 529 plan, you could be as aggressive or as conservative as you'd like. You control the dollars.
You set the allocation.
And you can set up 6 accounts for your 6 grandkids. You can have them be as aggressive as you'd like. You can control it. The beauty of these plans is the dollars grow tax deferred, and when the money comes out and it's used for education expenses, room and boards included, trade schools are included, it comes out tax free. So all the earnings are tax free.
And the benefit is you remain the owner of the account, not the child. So if the
Gotcha.
child gets to 25, 22, 23, and you're like, giving this kid 15 or 20 grand is not going to help them their lives. It will actually possibly make their lives worse. You can change the beneficiary on that account to another grandchild, or you could withdraw the money yourself and pay taxes and penalties on there. So that is one option. It is the option that I have chosen for my own children. It is the
me as
option
well.
that Scott has chosen for. It is the option that we recommend to about 95% of all our clients.
Now, here's a couple other avenues you can go. You can set up accounts that are what's called a Uniform Transfer to Minors Act or Uniform Gift to Minors Act. It's different states call it different things, but an UTMA or an UGMA.
Which, by the way, was the predominant way of funding college education prior to the advent of the 529
20
plan.
years ago or whatever.
Yes.
Yeah. With this, there's some benefits. This is a way that the money is set up in the kid's name, so you die or whatever, it remains in the kid's name. You'd have to set up 6 different accounts for each grandchild. A certain amount of interest, $750 a year or $800 a year, I forget the exact number, is free from any sort of income tax. And then it's taxed after that, and if it gets too high, it's taxed at the parents' rates. But that applies to such a small percentage of the population; it's almost irrelevant in this particular situation. The challenge with that sort of structure, and again, you can invest it in anything you want. You could invest it in a bank account, or you can invest it in Tesla stock, and anywhere in between. The downside to that is when the child reaches age of maturity. Those dollars are theirs regardless. So if they're more interested in cars than they are in college catalogs, they're probably going to take the money and buy a car or something like that.
And I remember when I was 20, a friend of mine all of a sudden shows up with a Carmen Ghia, right back in the day. Volkswagen
Correct.
Carmen Ghia. For those young kids, you won't know what a Carmen Ghia is. But a Carmen Ghia, and this kid had nothing. And I'm like, where did you get this Carmen Ghia? He goes, well, I had this fund my parents had been saving for me. And
I turned 21. Here it is.
And I got it. And he wrecked it 3 weeks later. I thought that was classic. He did.
So that's another avenue. And a third avenue is where you set up it's kind of a pain, but you set up 6 different accounts in your name or you and your wife's name or your trust name or however you hold your assets. And you just earmark them internally that I'm setting this up for Johnny, and no kid's named Johnny anymore, whatever.
Kyle.
Whatever their names are.
Devin.
And then you earmark them yourself. You're the one going to be responsible for any sort of capital gains or dividends or interest that are paid out over there. Presumably, you would invest in something that's more growth oriented, so it wouldn't be very
Right.
spend off much. And then you could gift those assets to the child later. Like, hey, by the way, I'd been saving up money. There's 10 grand that's in this account that I've got for you. And you could set up in your will or your trust such that if you die early, these dollars go into a certain trust to accomplish your objectives.
All right, so we gave you all the choices, the pros and cons. You want to use the 529 plan. You that's all you want to do. And what state are you in?
I am in Missouri, and real quick, my son, he has 3 of the grandkids out in California. So I told him to go ahead and start teaching them about stocks and buying. So he set up accounts in TD Ameritrade, and I told him to start teaching them right now.
That's right.
Of course, young people and kids' mind is all about gaming and techs and things of that nature. But I thought that would be a good idea for them to start.
Yep. And so what you want to do is just set these up. I don't know about the 529s are funny because each state is only allowed to have one. And so, but you don't.
Some states give you a tax deduction. Some states don't.
And you don't have to use the one that the state that
That's
you're
right.
actually resident.
I'd look to see if you get some tax deduction for the state of Missouri.
And if not, I'd use the state of Utah's plan, which is the one that.
Oh, okay. Utah, and I know Kansas definitely has that over there.
Well, they all have them. The question you want to see is if you get a deduction to the state of Missouri.
And then if the money's not used for any sort of education expenses whatsoever, worst case, you pay taxes and a 10% penalty on the gain.
And it comes back to you. But you can always rename another
That's right.
grandchild as a beneficiary.
One kid doesn't turn out so well, and you're like, that's not going to help him.
Yeah. So anyway, we appreciate your service to the Marine Corps and the U.S. Postal Service.
Thanks, Daryl. Appreciate the call. We wish you well. Let's continue on. 833-99-WORTH is the number. We're talking with Brian. Brian, you're with Allworth's Money Matters.
Hi, guys. Thanks for taking my call.
Yeah.
What can we do for you?
My question is on renting versus buying. So recently, I got a $20,000 raise that took my income from $90,000 to $110,000. I'm 35, single, no kids. And right now I've been budgeting and saving about half my income per month. So just background, I have $75,000 in savings and $125,000 in retirement accounts. So $250 all in. And I'm probably renting at below market. So a few things just on my mind is I like having cash in the bank and kind of worried about being, say, house poor if I get into something soon. And then I like to travel and could see living abroad 2 to 3 months out of the year. And then kind of, at what point, should I'll be stocking up cash. At what point do I really need to look at buying a house? Like what kind of timing? And then my impact, my wealth building for the long term by continuing to rent.
Do you want to own a house? Do you want to own the house you live in?
I'm starting to like the idea of owning a house, but to this point, I've kind of liked renting more to the fact that it's just more flexible. The month-to-month cost is pretty low.
I'm going to tell you a story right now, okay? This week.
So you're going to introduce him to your daughter.
No. So this week, my wife and I, the house we're in, we built 16 years ago. So we've been there quite a while. So we decided it'd be a good idea this last year to do some upkeep, do some redos. Which, by the way, when you start a redo project, it just kind of never ends. And then, so part of it, we redid our flooring, and our entire downstairs was this wood floor. It looks fine, whatever.
Some people call it a remodel, but many call it a marriage test.
Whatever. So these planks that you can kind of see a little bit of gap. So the guy was out like a couple different times. Some guy's out today with a couple other crew, and they're trying to do something. And the guy says to me, Scott, I'm going to give you my number. I just live not far from me. Anytime you have any issue, you just text me, and I'll come over. You just text me here. And I looked to the guy, and I said to my wife, I didn't realize that a new floor came with yet another relationship I have to manage in my life. That's exactly how I felt at the moment, right? Like, he's a fine enough guy, and maybe I'd enjoy having a meal with him or whatever, but like, in the middle of the workday, and so the last thing I felt like dealing with is the stupid floor in my house. When you rent, there's one relationship to manage, right? And it's not your checkbook either. It's someone else's. So there are other ways to build personal wealth besides owning a primary residence. When you own a home, you are consuming that home. If you're wise, not every American is, you pay down the mortgage over time, you get to retirement with your home paid off. If you're unwise, you continue to refinance it every few years, take the cash out, and increase your lifestyle, and you get to retirement with a house with a huge mortgage on it. But
you can rent and own investment properties all at the same time.
That would, if you're like, I want to get in the real estate market, that would be my recommendation.
So that's why I asked what your desire to actually own the home you're living in. And do you think that you're going to be relocating anytime in the next few years?
And by the way, I meant no offense to the nice gentleman who works on my floor.
He's actually tearing your floor up.
I'm sorry. I'm really sorry. So, it's not personal.
So, Brian, do you expect that you're going to be moving anytime soon?
Not necessarily, but I wouldn't rule it out. And I do like the idea of some income producing property, but I didn't know if, you should own your own personal residence first and then move on to
not if you're paying about.
Not if you're paying below market, but the reality is, yes, normally you would start with owning your own personal residence.
But if you think you might want to go live overseas, you might have that opportunity. But don't let a home.
But you would buy a home that you could convert to a rental if it was your primary residence.
Where do you live?
Sacramento.
Okay, so home prices aren't ridiculous. They're still a lot more expensive than other parts of the country for rental.
Yeah, you're ready to buy a home and settle down.
Settle down.
No, you're ready.
Maybe a duplex and live in one and rent out the other side.
Perfect. Or a condo. The duplexes aren't great because they don't. The resale value isn't the same as a single family, but a condo would most certainly make sense. In a newer condo or a standalone home, you most certainly can afford it, and you're probably ready for it.
Only buy one if you really want one.
That's right.
If you enjoy rent, there's other ways to build wealth.
That's right.
There are other ways to build wealth.
That's right.
This is Allworth Money Matters. We're taking a quick break. Stick around for our second half.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
And I think we're doing a great show anyway.
We're enjoying ourselves. Hey, but Scott,
We always enjoy ourselves.
we had notes from the marketing department here. This is the time of
Notes from the marketing department.
right? Did you see this? The next round of retirement workshops is Monday, January the 25th through the 28th. This is reading right off the sheet. You'll find these workshops beneficial if you made a resolution to get on top of your finances in 2021 and you're within 5 years of retirement. These workshops will help you. That came from the marketing department.
It'll help you figure out how much money you'll need to retire well. You'll learn the basic investment management strategies and determine how Social Security fits into your retirement paycheck.
That's the marketing. This is why you should actually get to this Zoom workshop. This is from Scott and Pat. This isn't a marketing. This is us believing that these workshops are good for you to attend to better understand your own financial situation, whether you become a client of Allworth or don't become a client of Allworth. We still think, if you had no intention of becoming a client of Allworth, you should still attend.
Look, we understand that there's a big number of people that listen to the podcast and the radio program. There's a large number of people that use our resources on our website. A smaller portion of that will engage us in any sort of engagement whatsoever, and a smaller portion of that ever actually become clients. That's fine.
That's how it works, right?
That's fine.
That's right. That's right. So the reason you want to attend this workshop is so that you better understand how to go into retirement, the things that you need to think of. And so you're actually doing the workshop, are you not?
I believe so.
So it's Monday, January 25th, and then
through Wednesday, January 28th.
A number of them. So go to allworthfinancial.com, allworthfinancial.com, and we're going to cover things like sources of income in retirement, risk in the portfolio, tax considerations, estate planning considerations, the things that you should be thinking about. Now, obviously, we'd like you as a client. I was bike riding with a friend of mine that was he was an assistant treasurer at a Fortune 100 company, and we were bike riding the other day. And he said, yeah, I met with a couple of retirement guys, and they recommended all this, blah, 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 blah. And I said, what did you think? He said, I don't think I need a financial plan. And I said, you might need some tax planning around the edges, but in terms of managing the portfolio, since
he's a treasurer.
He was a treasurer at a Fortune 100. I said, you probably don't need that. And then he said to me, you know what I do need, Pat? I'm like, what? He goes, I need someone to manage my money in case something happens to me because my wife will have no ability to actually manage this money. And I'm like, well, then you should actually form a relationship with a financial advisor without actually hiring them.
I had a client. He became a client, I believe, in 1994. A client for a number of years. I really enjoyed the guy a lot. And he would never bring a spouse in. And I'd say, Bill, his name wasn't Bill. Bill, you need to bring your spouse in. Because it's important that she gets to know me and trust me. And he never did. Finally, they come in one day together. He looks a little odd.
And you're wondering what's happening.
And we're talking, and he's talking a little odd. And she reaches out to me later that afternoon, calls and says, by the way, Bill's got Parkinson's, and he's listening to some cognitive stuff right now, right? And so he went through a couple of years before he eventually, unfortunately, passed away. He was a little older at the time of the diagnosis. But when he passed away, his wife didn't feel comfortable enough with me that she brought her sister with her. And her sister starts telling her how she needs, for tax write-offs, she should be buying a rental house. And I'm looking at this poor lady who's just widowed. This guy, they had done a phenomenal job saving. She never needed to worry about a dime the rest of her life. And here her loved one, her sister, is telling her that she needs to get a rental. Her sister doesn't know what she's talking about, frankly.
Yeah.
And at the time, I thought, I was angered at myself. Like, I should have insisted that more. That he brought it.
She didn't buy a rental, I hope.
No, she never did.
Oh, good. Because
would have made no difference.
and it would have complicated her life, and it would have ruined.
I told her, if your goal is to make sure you have as much money as possible when you die, downsize your house immediately, maybe get a little trailer somewhere, and then buy a bunch of rentals. And then
and
it's not going to make your life good.
Yeah. So, back to the attend the workshops. Go to allworthfinancial.com.
That was a long story, but
the reality is you're going to get something out of it, and it's easy. You just go. You're in your own home. You could even listen if you'd like. We'll serve wine. It's bring your own BYOW. You bring your own wine,
and we'll provide.
You sit in front of your computer. You drink whatever you want.
Drink whatever you want.
We
Eat
don't
whatever
care.
you want. You can eat with your mouth open.
We don't care, but it's Monday, January 25th through the 28th, and we're going to talk about...
Allworthfinancial.com is where you can... Allworthfinancial.com. By the way, if you don't get our weekend update, you can sign up for that as well. It's a great way to learn more about lots of good planning topics.
All right, so there is the marketing, advertising portion of the radio show. We will not do that again. We promise we're going to go right to the calls.
That's right. If you'd like to be part of the program, our number, 833-99-WORTH. Let's talk with Marcia. Marcia, you're with Allworth's Money Matters.
Hello. I would like your thoughts regarding estate planning related to leaving my house to my two sons, and without the worst tax consequences for them. I live in California. I've owned the house for 45 years. And it's currently in a revocable living trust.
Okay.
And recently in California, Prop 19 passed. Mm-hmm. And just wondering if, I should be doing anything. I know some of this might be legal stuff, but
what is your and not everyone's in California listens. So in the past, it used to be such that in California, our property taxes were fixed based on Prop 13, which was passed in the 70s, and I think most people in the country probably even heard about that because property taxes if you bought your home in 40 some years ago, your property taxes can only increase 2% a year, regardless of inflation. So you have people that have $1 million homes that are paying property tax at a value that's 15% of that or whatever.
Yes.
Right? And then your next door neighbor goes and moves next door and they're paying a high property tax. And it used to be that if you passed away, a direct heir of yours could inherit that house, and as long as they converted that home to their own primary residence, they can continue with that same low tax basis on the house. Right?
Yes.
Recent tax, this last election cycle, there was a bill that went through that was trying to, the intention was to provide some benefits to, at least how that was structured, some people, if they wanted to move different areas to transfer their tax bases forward. Was it just for people 55 and older, I think? Against and disabled. So. There was a bunch of list of us. But
wildfire.
But that's right, wildfire. But with that, it said you can no longer pass on the property tax basis to your heirs. There might have been a couple exceptions, but essentially eliminated.
But I don't know if this actually matters in your situation. Marcia, you're leaving it to two children. Would both children move into the house?
Probably not.
Would either of them move into the house?
Probably not.
Okay, well, then it's irrelevant. So you want to make sure, and the reason it's irrelevant, if they came into my office and you had passed away and they said, we inherited this house together, what do you think?
Sell the house and split the proceeds.
I would have them sell the house
99% of the time.
and split the proceeds almost immediately, unless they were in business already together and they had the best, most perfect relationship.
Or there
in
is
the
enough
world.
assets where someone says, I'll take the $500,000 house, you take the $500,000 in cash.
And that was one way you would do it. But you most certainly would want to split that property as quickly as possible or sell it and have that. And so the Prop 19 doesn't mean anything to you. So what you want to do is make sure that it is titled correctly in the name of your trust, and the trust gives direction to the disposition of the property at the time of death. That's what you want to make sure. Then you want to make sure that you have TODs on all your other accounts, or they're labeled in the name of the trust, and that the beneficiaries on your IRAs, life insurance, or anything that annuities have your children as the primary beneficiaries, unless there's restrictions on how the dollars are paid out in the trust. Are there restrictions on how the dollars are paid out in the trust?
No.
All right, that's all you got to do is just go through and make sure all your beneficiaries list your 2 children and make sure that all the property is in the name of the trust.
Yeah, it sounds like you're already set.
Yeah, it sounds fine.
Why did this trouble you?
It's a Prop 19.
Prop 19 is hard to understand.
That's right. And I've had a number of phone calls on Prop 19. It means nothing to you.
Okay.
It means nothing to you. And the reason is because of the disposition of the property at time of death. That's why it means nothing to you. All righty?
Okay, thank you.
All right, appreciate the call.
I think for most homeowners, it was a benefit. And
Yeah. But
as a taxpayer, I clearly understand why would you want to let a family member pass it down to generation?
Oh, yeah, I get it.
I mean, I understand, like, if you can't afford to pay your property taxes, why we need to have a mechanism in place so your property taxes don't chase you out of your house.
Yes.
Anyway.
But for most people, it was a non-issue. So.
All right, let's continue on here. Our contact number, 833-99-WORTH. Let's talk with Mary. Mary, you're with Allworth's Money Matters with Scott Hansen and Pat McLean. Hello.
Hello, Scott and Pat. Thank you for taking my call.
Yeah, thank you.
I am calling today. I have a question, and I'm looking for different options and the best way to handle it. So I met with my nephew and his wife over the holidays, and they were just telling me about their situation. They're both self-employed, and they just purchased a house in October 2018 for $85,000 at a 6.75% interest rate, and it's a 30-year fixed mortgage. They went in March to see about refinancing, and there was a $4,000 closing cost because they're self-employed. They didn't have that cash, so they didn't approve the refinancing. So they saved up the $4,000 and went back in November, and the interest rates are down to 2.8%. So they wanted to refinance an $80,000 loan, and they had the $4,000 closing. Well, at that time, the bank that they went to denied it because of things that were happening with COVID, and they just didn't approve it. So I was looking for a way that I might be able to help him.
Okay.
And different options. So I have about $40,000 cash. I have investments and retirement, pension, that kind of thing. So they would like to refinance at like 15 years. They could probably get it for less than 3% if the bank approved it, and for $80,000. And they would be paying the same amount, but they would cut their years from 30 to 15. Yeah, the problem is they haven't been able to get the loan. I don't know if they should keep shopping around, or I'm not liking the idea of co-signing a loan for them.
Yeah. Let me ask you,
what state is this in?
This is in New York State.
And what's the value of the home?
It's about 80. Well, they bought it for $85,000. It's not a lot more than that, probably.
It's amazing they could get a banker to talk to them at all for an $85,000 loan.
I think they.
It's amazing
went
that
to
there's
one
actually
bank.
homes in the United States that sell for $85,000.
Well, I assume it's probably in upstate New York somewhere.
It is. It's in an older community.
Yeah, it's small.
And they're kind of newlyweds. They've been married since October 2018, and they just started their family. So.
And what's their business? They're self-employed. Are they both in the same business or two different businesses?
Yeah, he is a photographer, and his wife is a wedding planner. So with COVID, that went down.
Yeah.
But in the meantime, they have certainly been able to keep up their payments and save enough money for a down payment or for a closing cost.
So Mary, if you called and you said, I've got $300,000 in the bank, I've got another $2 million in my retirement account, I really love my nephew, then I'd say, yeah, you could be the bank on it.
That's right, Scott. I was thinking exactly.
You could be the bank on it. And
that's what I'd like to do so they don't have to have that $4,000.
Well,
I just said if you had a few $100,000 in the bank and $1 million in your retirement account. So,
and by the way, full disclosure, my wife and I bought our first house. My grandmother lent us $20,000 for the down payment so we could get through PMI, payment mortgage insurance, so we didn't have to pay it. And I paid it off in a couple of years. And
my dad loaned me money to help with the down payment.
My grandmother tried to lend me money again because it was such a good return to her. She kept saying, Patrick, I could lend you some more money. And I'm like, I don't need it.
She liked the return.
She liked the return.
And my nephew also said, well, if you are going to be the financer, that we wouldn't want you to do it if you didn't get some kind of a percent. So
of course.
He would be willing to even give me a little bit of a percentage, which is much more than I'm getting in the bank.
Oh, no, you'd market it above market. You'd market at fair market, absolutely fair market. But the question is do you have the financial wherewithal without putting your retirement into jeopardy to do so? So tell us about you.
Yes. Okay. Well, right now I've got about $40,000 liquid cash in the bank. I've been working for many years. I'm in my 60s, early 60s. Good retirement pensions.
Are you retired now?
No, I'm not retired. I work full time. My home is paid for. I have no debt.
Do you work for the state or a municipality or utility?
No, I do not work for the state. I work in private industry.
Okay.
And what do you have? Do you have money in a 401k or IRA, that sort of thing?
Sure. Yes, I do.
How much?
401k. I also have a pension plan with my current employer who I've been with for over 20 years. And my employer before that was the state, and I worked with them for about 15 years. So I have.
And so what if you were to add up all your retirement accounts together, what do you have in those accounts?
Oh, that I'm not prepared to tell you because I didn't check. I'm not real good at
few $100,000?
Oh, yeah.
So the answer is without that being answered, we can't tell you. My first blush is that you're not prepared to do it.
The challenge is this: is your nephew, right? So let's envision down the road. Let's say you do this. Let's say that something happens. The marriage no longer works out.
That's right.
For whatever, maybe whatever, right? Something. Just life happens. Right? Marriage doesn't work out. Businesses don't work out.
Are you prepared to lose
they quit,
this?
They're not making the payments anymore.
You don't want a house in upstate New York.
Like Aunt Mary, we can't afford the payment this month. We can only send you $100, right? And the next thing you know, they're several months behind on their mortgage, and you're like, well, how do I evict my nephew?
You don't.
Because then you'd be the bad aunt.
You don't. And remember, bread that is eaten is soon forgotten. Bread that is eaten is soon forgotten.
So the reality is this. At some point in time, we're going to learn how to live with COVID-19, whether that's vaccine takes care of the problem or it's just the way things are going to go forward. And we'll figure out how to live through this. There will be events and weddings again. There will be photography. Right? One's a photographer, one's a
wedding planner.
Oh my gosh!
Wedding planner.
But the reality, this 6.75% sounds high, but this is commensurate with the risk that the lender is willing to actually take, and that's why this is such a premium over a normal interest rate, because either they have poor work history, poor credit, combination of the two, and a cash flow that is not consistent. I wouldn't touch this.
The reality is, look, they're young.
They'll be
figure
fine.
this out.
Yeah. They'll be fine. They'll be fine.
No, seriously, they'll figure it out. It's not the end of the world.
It's $85,000.
And the difference is 4% on 85. It's less than $4,000 a year. They would like to save that by getting a new mortgage to save them about a little under $4,000 a year.
That's right.
A new mortgage will save them $4,000 a year.
That's right. That's right. And if you feel that bad,
if it takes them another year, give them $4,000 if you feel that bad.
If you feel that bad, but the reality is, unless you had oodles of money laying around, which you don't know.
Well, you probably don't have a couple $1,000,000, and I wouldn't do this unless you had a couple $1,000,000.
That's right.
And being prepared to not see these dollars.
Yeah, you would if you lent them this money, should be.
You'd be
prepared.
better off just giving them some cash to help them through this.
Yeah,
if that's what you wanted. If that's what you wanted to do.
Yeah, I wouldn't.
That would be better. That would be more helpful to them than trying to pay this thing off.
Yeah,
and they're taking be in the bank.
The reason they're charging this $4,000 closing cost, which is a 5% closing cost, which is relatively high, is because they're building that into the price of the loan. That the risk that is commensurate with this type of loan, with this type of income, with this type of profession. You didn't create their lives. You're just a participant in it. You didn't do this to them, right? And you're a great aunt. I wish you were my aunt.
And it's not like they're in dire need.
They're fine,
right? If they were in dire need, then you'd probably say, like, all right, I'm going to. But the reality is, if you do this, there's a good chance that it will cost you not only financially, but relationally.
That would be my concern as well.
That's right.
So, I wouldn't want them to feel like they couldn't talk to me because they owe me money.
So if you talk to your nephew about this, you just go back and say, you talk to a financial advisor, and the financial advisor said it was strongly discourage you to do that because of any of your income needs.
And by the way, I feel bad for you. So here's $1,500, $2,000.
If you want to do that, or don't do that,
or don't do it.
Very good.
All right.
Okay,
and by the way,
so much.
By the way, Mary, you need to actually go and figure out where your money is and what it's doing.
Yeah.
And if you're a few years away from a retirement, when you retired from the state of California, did you take were you pension eligible, or was it a deferred vested pension?
Sure. No. I was pension eligible, but I have worked in New York State, lovely New York State.
Oh, you did? Okay.
Yeah.
Okay.
Yeah.
All right. Well, appreciate the call.
Okay. Well, thank you so much. I appreciate your time.
Right,
have a great day.
And it's
how many relationships have you seen torn apart, Scott, with clients lending money to their children, nephews, grandchildren? I have told my clients, you're better off giving it to them than you are lending it to them. And at least that way it's over.
I know
with.
we've both lent money to people in our lives before, and it's if you don't get to the point of like, I might not get it back, then it'll eat you up.
During the last the home crisis, I still remember a couple of my friends asked me to, they were way upside down on their mortgages and they were going into foreclosure, and they said, "Will you buy this house in foreclosure and then let me live in it and rent it to me, or put me on a payment plan where I can buy it back from you slowly?" And I would say no, and they said, "Well, let me show you the numbers." And I said, "The answer is no." And they're like, "Why is it no?" And I said, "Because I could never actually foreclose on you." And
of course not.
Because you're my friend. But if you're in tough straits and you need some money, ask me. By the way, if you're my friend and you're hearing this, don't ask me.
This is hypothetical. This isn't real life.
But the reality is, doing things to make yourself financially, your life better versus being in dire need are completely different things.
Well, and money doesn't always make things better.
That's right.
And oftentimes people need to live through experiences. We all want our kids and our other family members to grow up to be responsible, functioning members of society, have some stability in their lives, right? All of that. Flourishing careers, strong relationships, of course, everything, right? We want them to flourish.
We want them to be creative, artistic, intelligent, good-looking.
A great friend to many.
All those things. Philanthropic, culturally minded.
But on the financial part, what makes people to have the ability to have financial independence typically comes through years of experiences.
Oftentimes painful.
Yes. Learning through those struggles you go through. And so sometimes we watch people bail their kids out
again and again.
And then look, if you've got $100 million and you could spend whatever you want on your kids, and then whatever, that's your business. What you don't want to do, what we see too often, you don't have $100 million. You got $1 million maybe saved up for retirement, maybe even a couple $1 million saved up for retirement. Not so much that you can afford to lose a big chunk of it. And sometimes people will give these financial gifts or invest in their kids' businesses and stuff, thinking that they're helping their kids. Not only are they not helping their kids, they're not helping themselves at the same time.
Especially if it's going to affect their retirement.
Impact their standard of living.
Yes.
So their standard of living went down, and I would argue their children's standard of living went down as well because they didn't have the opportunity to live through that experiences.
And more capital, more money isn't always the answer. It appears to be the answer. Look at state and federal government. We can fix this if we only had more money.
It's always the answer.
If we only had more money, we could fix this. We could fix the homeless problem of mental health. We could fix it if we had more money. Fix it if we had more money.
It's not about the process or the people.
No. It's always the lack of resources.
Always the lack of resources.
Always.
But I know it gets tempting.
Right. Well, sorry about that government rant there. I couldn't help myself.
Yeah, we've got about a minute left. And what we've not talked about in a while, Bitcoin.
Yes.
What was the bank that put a target of $160,000, $170,000? JP Morgan or one of the big ones?
Yeah, it was a respectable bank.
Don't hold me to the name, but it was, yes.
Yeah, I
was an analyst at the bank.
I didn't even read the article. I read the headline.
I didn't read the article either.
I read the headline.
Why do I need to read every financial article?
I read the headline in the first paragraph, and I'm like, okay.
Look, if you want to, if you're buying an investment because it's done well lately, it does not guarantee that it's going to continue to do well in the future. And if you're going to invest, I don't care whether it's Bitcoin or some other asset that's been on fire as of the last few weeks, be prepared for it to have a major downturn at the same time. And of course, we saw that with Bitcoin. It went from 20,000-ish to 6,000-ish or something like that.
And
now
it's way up.
I don't even know where it is today, but it's kind of irrelevant, I believe, to most of our lives. Anyway, we're out of time. It's been a real pleasure having you with us. You could always get a podcast of this program. If you listen to it via radio, you can get a podcast. Just go to our website, allworthfinancial.com, or wherever you get your podcast, wherever you download your podcast, you'll find us as well, Allworth Financial's Money Matters. Enjoy the rest of your weekend. This has been Allworth Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.